Welcome to another podcast of the Riffle series. The Riffle, that's a podcast series brought to you by 10 Leaves. So today we're doing a deep dive into something pretty fascinating, actually. How regulators, financial regulators, are getting ready for, well, a future where your investment advice might not come from a person anymore.
Right, but from an algorithm.
Exactly. And not just simple rules, we're talking real learning AI. Our source today is the Supplementary Guidance on Digital Investment Management, DIM, they call it, from the ADGM's Financial Services Regulatory Authority. That's the FSRA in Abu Dhabi.
And it's a really interesting piece of guidance because, it really tackles the shift head on.
It does. So our mission then?
Well, I think our mission is to unpack this specific framework. It's designed just for these digital investment managers, these DIMs, and really understand what unique risks they see and the safeguards they're putting in place.
Basically, how a major financial hub is trying to regulate AI in finance.
Pretty much. It's a blueprint for managing automation and AI risks, especially for, the mass affluent investor who might be using these platforms.
Okay, so let's start right there. What exactly is a digital investment manager, or DIM, according to this ADGM guidance?
So the core definition they give is providing investment management services using algorithm-based tools. And the key thing is it requires limited or optional human interaction.
Limited or optional, so it could be almost entirely automated.
Exactly. That's the point. It's meant to be, cost-effective, scalable, really suited for those mass affluent clients who actually prefer digital channels.
And when they say algorithm-based tools, we're not just talking about simple if-then logic, are we?
No, definitely not. And this is crucial, I think. Footnote 1 explicitly mentions things like generative AI, large language models, or LLMs, and machine learning.
Wow, okay, so they're really looking ahead, regulating the cutting edge, not just what's common now.
That's right. They're building a framework that anticipates where the tech is going.
So these DIMs, how do they typically operate? The guidance mentions a couple of main business models, particularly in the GCC region.
Yeah, they sort of fall into two main buckets. First, there's the fully digital model. Here, you have very little human interaction, maybe just IT support for technical issues.
Pure robo-advisor, essentially.
Pretty much. And then the second is the hybrid model. This is where clients can choose to talk to a human advisor, to discuss the advice the algorithm spits out.
Okay, so you get the automated suggestion, but you can still have a conversation about it if you want.
Exactly. Gives people that option, that comfort level, maybe.
And the regulator, the FSRA, makes a point that these models, whether fully digital or hybrid, they present different kinds of risks compared to traditional investment management.
Yes, that's a core distinction they make. They highlight differences in the investment process itself, obviously the reliance on technology, how suitability is assessed, and the disclosures needed.
Right, because if an algorithm is making the call, suitability isn't a conversation, it's based on the data you input.
Precisely. And those different risks lead directly into what permissions these firms need to operate in the ADGM.
So let's talk permissions. To run a DIM in ADGM, you need a financial services permission, an FSP. What specific activities trigger this?
The FSRA notes three main regulated activities they typically see DIMs doing. First is advising on investments or credit. Think about automatically recommending a portfolio rebalance.
Okay, so the recommendation itself.
Yes. Then second, managing assets. This is where the DIM actually has discretion to execute that rebalance, instructing a broker without needing specific client consent each time.
Ah, so taking direct control.
Exactly. And the third one is arranging deals and investments. This is more like passing instructions to a broker, but after the client has given their okay.
Got it. So advising, managing, or arranging. And these different activities have pretty big consequences for how much capital the firm needs, right? There's a table in the guidance.
Oh, absolutely. The capital requirements are starkly different, and it really signals the FSRA's approach to risk.
Talk us through that. What's the difference?
Well, if a DIM is managing assets, exercising that discretion, potentially holding client money or assets, they fall into Prudential Category 3C.
And that means?
That means a base capital requirement of $250,000, plus their minimum capital is the higher of that base amount, or what's called the expenditure-based capital minimum, which involves calculating a fraction of their annual audited spending, 1850 seconds if they hold client assets, 1350 seconds if they don't. It gets complicated, but the point is it's substantial.
$250,000 base.
Okay.
But what if they don't manage assets directly? What if they just advise or arrange?
Well, then it changes significantly. If they stick to advising, arranging deals, maybe arranging custody, but not managing assets with discretion, they fall into Category 4.
And the capital for Category 4?
The base requirement there is only $50,000.
Wow, okay. 250K versus 50K. That's a huge difference.
It is. It's a 5-to-1 difference on the base requirement, and it seems like a clear regulatory incentive, doesn't it?
It really does.
Yeah.
It's like they're saying, innovate with advice, use algorithms, that's fine, and the barrier's lower. But if you want direct control over client money using tech, well, the financial stakes are much higher.
Precisely. And there's a footnote that if a DIM does a mix of activities across categories, the highest category's capital requirement applies. So you can't escape the $250K if you manage assets at all.
That makes sense. But there's also a bit of a carrot here too, isn't there? Something about regulatory relief.
Yes, that's another interesting part. The FSRA says they might modify or even waive some prudential rules or other requirements on a case-by-case basis.
But only if.
Only if the DIM uses technology in a way that actually helps the FSRA supervise better, or helps the firm manage its own risks better, or just generally leads to better regulatory outcomes.
So if your tech makes you more transparent or easier to supervise, you might get a regulatory discount, essentially.
Kind of, yeah. It encourages firms to invest in good reg tech, good compliance tech, not just the client-facing algorithm. It promotes responsible innovation.
Okay, so lower capital for advice only, but potentially massive scrutiny on the tech itself. Let's dig into that. The algorithm, or the model as they call it, is obviously central. How does ADGM expect firms to govern this core piece of technology?
Right. The governance around the algorithm is critical. The guidance is very clear. The board and senior management have ultimate responsibility. They need robust oversight and control over the whole lifecycle design, testing, performance, deployment, security, the lot.
And this is because the tech itself introduces unique risks, things you wouldn't see in traditional management.
Exactly. They specifically call out risks like model poisoning, model drift, and even adversarial manipulation. These aren't your typical market or credit risks.
Okay, you have to explain those. Model poisoning sounds sinister.
It kind of is. Model poisoning is where malicious actors deliberately feed bad data into the algorithm's training process. The goal is to make the model learn the wrong things, leading it to give bad advice or make poor decisions later on.
So sabotaging the AI from the inside via its data.
Pretty much. And then model drift is maybe less dramatic, but just as important. It's when the world changes, market conditions shift, user behavior evolves, but the model doesn't adapt. So a model that was once accurate gradually becomes less relevant or even wrong over time.
Because it's stuck using old assumptions.
Correct. And adversarial manipulation is, well, trying to trick the algorithm in real time, finding inputs that exploit its weaknesses to get a desired, possibly harmful outcome.
So how does the governance structure mandated by ADGM address these scary tech risks? What do firms actually have to do?
It comes down to several key things. First, developing and testing the model. The logic behind the algorithm must be properly documented.
Why document it?
So that the outcomes are explainable, traceable, and repeatable. You can't have a black box making investment decisions for clients. Regulators need to be able to understand why it did what it did.
The show your work principle applied to AI.
Exactly. They also stress that the client questionnaire, the RPQ we'll talk about later, needs to account for potential behavioral biases that might skew client answers. And for complex models, they might even require a third-party audit to validate it.
An independent check on the algorithm's performance. Makes sense. What about once it's built? Managing and maintaining it.
Yeah, ongoing management is crucial. They mandate clear safeguards like access controls and security protocols to protect the integrity of the source code. You don't want unauthorized changes.
Preventing accidental drift or malicious poisoning, presumably.
Right. And the firm absolutely must have the resources and capability to modify or even stop the algorithm if needed. If something goes wrong, you need an off switch or at least a way to intervene quickly.
And a backup plan.
Definitely. Mandatory contingency plans for failure or outages are required, specifically focused on protecting client interests during any disruption.
Okay, and then there's monitoring, I assume. You can't just launch it and forget it.
No way. Ongoing monitoring is essential. Regular reviews to detect risks of inaccuracy, bias, or exceptions. Plus, the board and senior management need to periodically review the whole internal governance structure itself to make sure it's still effective.
It sounds incredibly thorough. It's not just regulating the financial outcome, but the entire technological process.
That's the heart of it. And alongside this algorithm governance, there are other key controls. Given the heavy reliance on client data, robust data security policies aligned with ADGM's data protection regulations are non-negotiable.
Understandable. Sensitive financial and personal data flying around.
And also a very strong emphasis on anti-money laundering and targeted financial sanctions, AML and TFS obligations. Digital platforms can unfortunately be misused for illicit finance, so the controls need to be tight.
Okay, that covers the tech and governance side. Let's pivot to the client. With potentially minimal human interaction, how does the FSRA ensure investments are actually suitable for the client? That seems like a huge challenge for an automated system.
It is a huge challenge, and it hinges almost entirely on the risk profile questionnaire, the RPQ. The standard conduct of business rules about suitability still apply, of course, but the RPQ is the primary tool DIMS use to gather that crucial client information.
So the quality of that questionnaire is paramount.
Absolutely. The guidance stresses proportionality. The information you collect needs to be proportionate to the complexity and risk of the investments being offered.
Meaning a simple ETF platform needs less info than one offering complex derivatives.
Exactly that. You don't need a 100-question ordeal for a basic service. But crucially, the RPQ must include knockout questions.
Knockout questions. To do what?
To screen out clients for whom the service is fundamentally unsuitable right from the start. For example, if a client's stated liquidity needs or investment horizon just don't align at all with the products the DIM offers, a knockout question should identify that and prevent them from proceeding.
So it's a basic suitability filter built into the onboarding. What about inconsistencies in the data a client provides? People aren't always logical.
Yeah, the guidance addresses that too. If a client gives answers that seem contradictory, like claiming very high risk tolerance but also having very low income or short-term goals, the DIM has to deal with it.
Ow.
It usually means triggering follow-up questions within the digital flow, or in a hybrid model, flagging it for review by a human advisor. You can't just ignore obvious red flags in the data.
Okay. Now, here's a tricky one. What if the system does its job, processes the RPQ, recommends portfolio A, but the client, using the platform, decides they want portfolio C instead? They override the recommendation.
That's a critical scenario they cover. If a client actively chooses a portfolio that the system did not recommend based on their RPQ, the DIM isn't just allowed to let it happen silently.
They have to do something.
Yes. They must provide clear information to the client explaining why the originally recommended portfolio A in your example, was considered suitable, explicitly linking it back to the client's own RPQ answers.
So it forces a moment of reflection. The system thinks this other thing is right for you based on what you told us. Are you sure you want to proceed with your choice?
Exactly. It reinforces informed consent and, frankly, probably serves as a liability management tool for the DIM as well. It documents that the client went against the personalized recommendation despite being warned.
It does raise questions about how truly protected the client is if they can just click OK and ignore the warning, but I see the logic in documenting it. And keeping that RPQ data current must be important too.
Very. The guidance says DIMs need to periodically prompt clients to update their information. This could mean retaking the whole RPQ, or maybe just targeted questions about changed circumstances, like income or goals. The algorithm is only as good as the data it has, right?
True. Garbage in, garbage out, amplified by AI. Okay, last major area, disclosure. What specific things must DIMs tell clients, especially retail clients, that go beyond standard investment disclosures?
Given the centrality of the algorithm, the disclosures have to be about the technology itself. They must be clear, fair, and not misleading, of course. But the unique DIM disclosures include
Go on.
details of how the algorithm is actually relied upon in the whole investment process. What does it do? Also, the key assumptions and limitations baked into that algorithm model. What can't it do? What scenarios might it struggle with?
So being upfront about the model's weaknesses, not just its strengths.
Yes. And also the degree of human involvement and oversight. Is there a human checking the results? How often? Under what circumstances? Clients need to know that.
It seems really important. And what about when things go wrong?
They have to disclose the circumstances where the algorithm might fail to perform as expected, or situations where the DIM might need to manually halt trading or make material adjustments, think extreme market volatility, and crucially, what the impact on the client would be in those scenarios.
Preparing them for edge cases or crises.
Right. And finally, disclosing any other inherent material risks that arise just from this automated business model itself. For example, the specific risks associated with automated portfolio rebalancing, which might trigger trades or tax events the client wasn't manually expecting.
Basically, making sure the client understands they're dealing with a machine, its logic, its limitations, and its potential failure points.
Exactly. It's about demystifying the technology to the extent possible for the end user.
Okay, let's try and pull this all together.
Yeah.
If you had to synthesize the core takeaway from this ADGM guidance, what would it be?
Well, I think the core insight is that ADGM is embracing the efficiency of AI in investment management, no doubt about it. They see the benefits for cost, scale, reaching the mass affluent,
Like,
but they're pairing that embrace with a really specific, rigorous set of controls. They're saying, okay, you can use these powerful tools, maybe even with lower capital if you just advise, but you need exceptional governance over the tech itself. Transparency, explainability, reliability, human oversight. These aren't optional extras, they're fundamental.
So it's a trade-off. Operational freedom via tech, balanced by intense technological scrutiny.
I think that's a good way to put it. And if you connect it to the bigger picture, you see a regulator really moving beyond just looking at financial statements and compliance checklists. They're getting into the weeds of governing the code itself.
Demanding that the algorithm be manageable, auditable, explainable.
Yes. Ensuring that the technology, which is replacing human judgment in many cases, is robust and trustworthy enough to do so safely, particularly for retail or mass affluent clients.
Which brings us to a final thought, perhaps a provocative one. The guidance explicitly includes generative AI and LLMs in its definition of algorithms. These aren't static decision trees. They learn, they evolve, their internal workings can be opaque even to their creator sometimes.
That's the challenge.
So how do regulators globally, not just ADGM, effectively supervise and ensure explainability and traceability for financial algorithms that are constantly changing, potentially in unpredictable ways? What does traceability even mean when the intelligence is genuinely artificial and self-modifying?
That is the billion-dollar question, isn't it? How do you regulate something that learns and changes faster than traditional oversight cycles? Defining accountability, ensuring fairness, preventing hidden biases when the machine itself is evolving. It's probably the next frontier for financial regulation in the AI age.
A fascinating challenge indeed. We'll have to leave it there for this deep dive.
A lot to think about.